all, thank you all for being here. Some of you are coming in not as members of Invest for Better. So let me give you just a brief introduction of myself and this organization. So my name is Janine Firpo, and I'm one of the co-founders of Invest for Better. And what we do is we empower women to invest their money in ways that help them, help their families, and help the world. And we're really looking for women to grow into very confident, values-aligned investors. And we do that with a variety of programs, this being one of them. Every month, we have a couple of guest speakers who come on and talk about different things related to investing. We also have people come and talk about specific investments and have open office hours as well. So the way that we're going to run our session today is I'm going to first introduce our guest, and then he's going to speak for about 30 minutes. I will kick us off a question and answer period with a couple of questions of my own, and then we'll open it up for the rest of you. When we get to that community Q&A portion, we're going to turn off the video. We are recording this. But we will turn off that portion so that you can ask whatever questions you want in privacy, and you don't have to worry that your video or your questions will be available either to our members or elsewise. I also want to put out a disclaimer, as always. So we are an educational organization, and even though we are presenting information about investing, and you may even hear about some specific investments from Michael, we do not endorse them, nor are we recommending them. This programming is for educational and informational purposes only. And if you're hearing my dog barking, my apologies. Today is garbage day, so the garbage people are coming. And this is the joy and the problem of living in the world of Zoom. So he will stop shortly, I hope. Anyway, that's sort of my preamble. That's how we're going to run the event today. And now I would love to introduce our guest speaker, who is Micheal Pellman Rowland. And as I mentioned earlier, he's actually coming to us from Monaco. So he's coming from across the world sort of to talk to us. And he is really an expert in the area of food and ag financing and investment. He's one of the foremost experts in this area. He did a lot of writing for Forbes on this topic. He was also a senior advisor at Morgan Stanley for many years, and he is now sitting on the board of many organizations that are looking at the role that food and agriculture and changes in those structures can help us get to a better outcome with climate, with the way we live, the way we eat, all of those things. And he and all of his colleagues are really passionate about changing the world through food. And so he's going to take us and walk us through an introduction to what that means. What are the different areas of focus and topic in this today? What are people investing in? What is forefront in their minds? And he's even going to speak to us about some investments and give us some very specific examples. If you were with us last week, then you may have been here when Elspeth Alfano spoke about food and ag as well. She talked about how you could invest in the public markets. Micheal is going to be focusing more on the private markets today. And so he and I have spoken a little bit about this. He's super knowledgeable, and I'm really excited to hear what he has to say and to share that with you. So Micheal, thank you so much for being here and taking the time in your evening to join us. We really appreciate it. And the floor is all yours.
Great. Thank you, Janine. And quick shout out to Jenna. Great to see her face. Old Hamilton alumni, small world. So yes, thank you all for being here. I'll give you just a quick sort of background as to how I got involved in this space and why it's meaningful to me personally. I'll touch on a little bit of, the sort of the food system and why it's relevant increasingly for investors, and then can sort of finish up with some concrete examples, and then leave, hopefully a good chunk at the end for engagement, Q&A, and so on, because that often is where most of the fun can be had, as opposed to me just sitting here and talking the whole time. So as Janine mentioned, I started off at Morgan Stanley right out of college. I've always been in the private wealth management space. Initially, I was working with same-sex couples in the pre-marriage equality days. And so that was, sort of my first foray into socially responsible investing. And so I was already sort of primed and ready for, figuring out ways to make finance more impactful. And then I met my wife in 2012, who gave me a very quick download on the food system, pesticides, factory farming, you name it. And before I knew it, I was, sort of charged and ready to think about ways that I could, approach the food system through my day job to make it better. And so that's what led me to be fully focused on impact investing with a particular passion for food, back in 2012. About 4 years into that journey, I decided to become a journalist, sort of at night and on weekends, to write about startups as a way just to have more impact beyond what I could do in my day job. And was sort of early writing about a lot of alternative protein companies and food waste technologies, and it's really just a way for me to feel like I could have a bit more influence on the world beyond just the people that I was advising. So that's sort of how I got here. I now advise families sort of around the globe on their broader impact investments, but food is certainly where I'm most well versed and where we've been most active in making investments on behalf of our clients. So, food is sort of a big deal when we think about things like climate change. Most often we think about fossil fuels, CO2, and that's obviously a big piece of the climate problem, but often overlooked, and thankfully less so these days, is food, and where actually you and I have the most control over our day-to-day lives, and the role that food can play in either driving positive or negative health outcomes, and other externalities like water scarcity, biodiversity, deforestation, and so on. So food makes up about a third of all emissions, and it's actually closer to about half of the emissions that each of us actually control day to day. And just to give you some perspective, when we think about flying planes or driving cars, transportation only makes up about 18%. So it's a vastly smaller piece than you might think when you see big planes in the sky and wall to wall traffic and rush hour. How we eat and what we eat is at least twice the impact day to day around the world when it comes to climate. So that's sort of at a high level why it matters. And food, outside of some of the novel ways in which we've figured out how to make more of it, has largely been sort of a stagnant industry for quite a long time, certainly relative to things like technology and other industries that have, become vastly different over the last couple of decades. And so it's through things like technology that's allowing food to finally start shifting and doing things it couldn't do before. And part of that's because you also have just a lot of entrepreneurs and smart people who are not necessarily going to the Goldman Sachs's and McKinsey of the world anymore, and they're figuring out how they can start companies that can make a difference and leverage these technologies to make food more healthy, make it more sustainable, and cheaper. Because as some of you may be aware, eating well is not always affordable. And so figuring out ways to make food not only better for the world, but also better for us and accessible for all is sort of the trinity of how we figure out, how to take food from where it is now to where we'd ideally like it to be. So I think about food in sort of three primary buckets when we're talking about, the future of food. Protein is one. Ag tech or agricultural technology is two, and the third I would call regenerative agriculture, or sort of regenerating farmland and natural ecosystems. So when we think about proteins, you've probably all heard and read about the impact that animal protein, particularly beef, has on the world. It's about 30 plus calories into a cow, for example, to get 1 calorie out. The most sustainable form of animal protein, I think, is chicken, which is about 8 calories in for every calorie out. So we end up feeding a lot of the world's food to animals to get a lot less back. So it's not wonderfully efficient. Trouble is, it tastes delicious, gives us a lot of really nice nutritional benefits, and we've been doing it for a long time. So figuring out how to reimagine protein to sort of make the same kinds of foods that we love and enjoy that give us the same nutritional value, but with substantially less water and energy and feed and land seems like a very important place to focus one's efforts. Agriculture technology, that's very sort of broad term, but it really encapsulates almost everything that has to do with the food system and how we're trying to use technology to lower the impact that that food system's having on the world. So that's everything from coming up with novel natural compounds to replace pesticides and other harmful chemicals that we use to make our food system more resilient. That's the ability to have supply chain traceability to understand where food is actually coming from. There's a substantial amount of our food that we eat that's not what they say it is. There's been reports of upwards of 40% of our seafood is mislabeled. So if it says it's carp, it's actually something else. And that's also important when it comes to labor, because there's unfortunately a very horrible level of slave labor and just other horrible conditions that go on in the world, particularly on fishing vessels. And so the better the world can get at being able to track, food from, farm to plate or sea to plate becomes incredibly important, particularly for these large corporates that really want to make sure they're not buying from, bad actors or farms that are, effectively employing indentured servants. So ag tech kind of encapsulates everything that technology is trying to address to make the components of how we grow food and deliver food more sustainable. And then the third is regenerative farmland. And so that's, if you think about the US, it sounds like probably most of the people on the call are US based. Only about 1% of farms in the US are certified organic. And even the organic standards in the US are a little like Swiss cheese. There's a lot of holes in it. So there's a lot of gray areas. There's a lot of Turkish grain that kind of shows up in the US with USDA labels on it. So why that's bad is that it just basically means that there's a lot that's allowed to be sprayed on farm, whether it's pesticides, herbicides, fungicides, you name it, that not only end up in that food, but they also end up in waterways. And so they end up creating massive algae blooms around Mexico, which is really bad for ocean acidification. It's bad for sea life, and it's certainly bad for the people who eat that food and drink that water. And so all regenerative farmland is really saying is, hey, look, if we can figure out not only ways to sustain this, which is a very common word in impact investing, sustainable investing, if we can actually go beyond that and actually regenerate these ecosystems to rebuild biodiversity, to rebuild soil health, that can go a long way to sort of healing a lot of the damage that we've done to these natural ecosystems through our farming techniques. So at a high level, I like to think of those three buckets, like when I'm talking to clients, as like the core categories to focus on. There are other areas that are complementary, but I think if you're thinking about investing in food, particularly in the private markets, those are sort of important buckets to sort of crystallize and think about. And they're complementary because investing in, sort of alternative proteins or more sustainable forms of protein is a complement to the technologies that are going to be important, on farm and in the food system. And then the farmland component is a separate and distinct piece of that, which is also helpful for diversification benefits, because oftentimes if you're investing in regenerative farmland related opportunities, you're actually owning some piece of farms, or you're owning a piece of a fund that owns farms. And that's something that you would call a real asset. It's tangible. You can actually go there and roll around in it, unlike a company that you might invest in that's technically a story and it's an idea. It's not technically real other than the laws that we've created to make it so. And that has good diversification benefits when you're owning real assets similar to a house or gold or things that you can actually hold that complement companies that you invest in. Because real assets traditionally are less volatile, they're a little bit less risky. And when you incorporate them in a portfolio of your stocks and bonds, and even some of your private, equity holdings, having a real asset like farmland can actually lower the overall risk of your portfolio because it becomes a bit more diversified. So those are some of the additional reasons that thinking about farmland and regenerative agriculture can be beneficial beyond just the merits of what is looking to be accomplished. So I'm going to give a few examples of some investments that we've made and I've made personally in the past, just to add some texture to what I'm describing. I'm not going to go in super deep detail, but I'm just going to give you some names and some examples and, a brief, sort of overview of what they do, just to give you a sense of some of the things that are out there. So one of them is a fund called Desert Bloom. Their whole mission is to try to make healthy, sustainable food affordable. So the name actually comes from the idea that there are food deserts all across the US and across the world, where people have to drive many, many miles even to find a vegetable. And so even when they find it, it's often not necessarily healthy or not necessarily affordable for various reasons. And so the idea is, can we figure out a way to invest in companies that are making healthy food not only affordable, but more accessible? So that's the general premise. And so they've gone out and raised, I think it was about a $50 million fund or so, I forget the exact number, which closed back in 2019, 2020. And they go out and invest in early stage companies that are seeking to solve that challenge in one way or another. And so it was sort of a unique approach that I came across that I hadn't found before, that was thinking about, food accessibility, healthy food accessibility, because it's so sadly difficult, to come by for large pockets of the population, not just in the US, but around the world. So that's one example. Another is called Clear Frontier. This was a fund that closed last year. And what they did was they raised $250 million to go out and buy up different farms around the US to convert them to organic and regenerative practices. So basically the idea is they raise all that money, they buy farms in places like Indiana, Iowa, North Carolina, New York, and they create incentives for the farmers to and know-how and support to convert from these traditional practices that are more damaging to the environment and to the ecosystems to these more regenerative practices that actually produce higher levels of income for those farmers. The challenge is that you need 3 years from when you start organic practices to actually be able to label your produce as such. And in that 3 years, you're basically spending more money and doing all this extra work while you're not able to actually sell your product with that organic label that commands a premium in the marketplace. And most farmers operate on 1-year leases. They don't very often own the farmland. They're basically renting the ability to farm on it. And so even if a farmer wants to do the right thing or focus on organic or regenerative practices, the dynamic is such where if they've got a 1-year lease, but they need 3 years to make the conversion, the incentives just aren't lined up. And so funds like this have been created to give farmers 5-year leases, 7-year leases, 10-year leases, and encourage them to do this, and then give them know-how, give them technical support, and other best practices that not only encourage them to do it, but increase the likelihood that they're going to do it well. And so that's sort of the basic tenets of what Clear Frontier is out to solve. And it's run by I think, 3rd or 4th or 5th generation farmer as well, which is obviously important when you're having conversations with farmers who are inherently and understandably skeptical of outside capital coming in telling them on how to run their farming industry. Another one is a fund called Sustainable Food Ventures. And what they're doing is investing in very, very early, very often what you call pre-seed or seed investments, some of the earliest money you can give to a company in alternative proteins. So that's everything from plant-based proteins, which is like a Beyond Meat type thing, fermented proteins, where similar to beer, you're brewing proteins in a vat and then able to produce meat and dairy and other proteins that are biologically equivalent or thereabouts to an actual chicken or fish or cow. And then there's something called cellular agriculture, where they're actually taking the cells of the animal that they're trying to recreate. That could be a tuna, could be a chicken, could be a lamb. And then they grow it in a suitable medium that allows the cells to proliferate. And voila, you've got actual meat, but you didn't raise an animal or catch a fish to get it. And so this fund is specifically targeting companies that seem to have the most promising technology, but very, very early stage. So it's super high risk. But that's offset by the fact, and this is done through Angel List, that the minimum investment is like $5,000. So it's very, very low from a minimum standpoint. Like every quarter, you basically have the ability to write another $5,000 check if you decide to, but through no obligation. And every quarter, there's sort of a new round of companies that they're putting some money into to help seed them. And so this is worth mentioning because some of the other funds that I've mentioned thus far command much higher minimums. Clear Frontier, I think, was around like 250 to 500,000. I think it was actually higher, but we were in some instances able to negotiate lower minimums because we had a few clients coming in. Desert Bloom was around 250. So one of the downsides to investing in private markets is the minimums can be often quite high. And so the reason I like to highlight sustainable food ventures is their sole purpose was to try to democratize access to investing in these types of companies without these bloated minimums that are, often out of reach for a lot of even wealthy investors, let alone, the average investor. So that's, one that's worth, taking a look at. Another one that's distinct from these is one that's called Ag Funder. You may have heard of them because they also have a very popular media arm. They put out a lot of great content and articles, but they also have a venture capital arm where they've raised money. They've done upwards of 5 funds over the last number of years, I think going back to 2017. And they invest in ag tech and that kind of second bucket that I referenced. So that's anything under the tent of the food system that they might want to be investing in. So alternatives to pesticides, robots that automatically neutralize weeds without having to have people in the farms weeding, drones that are dropping seedlings into the forest to plant trees. I mean, anything you can think of that's leveraging unique ways to take technology and make it easier for us to farm, either on farm or through agroforestry more sustainably, they're looking to invest in it. And they've, thus far been, doing a great job in the vintage that we invested in back in 2019. So those are all funds as examples. I'll give you a couple companies as well. One is a company called Fable Foods, which is actually Australian, and they are a mushroom meat business. So their products have, I think like less than 10 ingredients. It's predominantly mushrooms. But it's got a really neat story where you're familiar with portobello mushrooms or shiitake mushrooms. Actually, you've got those stems that very often you cut off because they're a little more fibrous and kind of chewy. And so most of the time, if you cook those, you cut them and you toss it and then you keep the cap and you eat that. But what they realize is that in those stems, there's actually quite a lot of nutrition, quite a lot of fiber, and it's basically getting wasted. And so they signed an agreement with the largest shiitake mushroom grower in the world, which is in Japan, to buy that from them at a very cheap price because it's basically a waste product. And they're turning that into products like pulled pork and shredded meat products and other things that are, when you strip apart these stems, are quite similar to a meat product, particularly because it has that umami flavoring, high, vitamin B, good protein content, and certainly more attractive to people who are less apt to maybe buy a Beyond Burger or things that they think of as more processed. This is something that's considered a bit more better for you and clean label in the alt protein category. And so that seemed to us to be like a very cool approach, one that would have great margins and address a growing need in the marketplace for, companies like Chipotle, for example, that will never put a Beyond Meat or Impossible Foods product on their menu, but they'll put something like Fable Food on the, meat mushroom burger or mushroom pulled pork on their menu because it's got more of a clean label and that's more important to them. So we saw that as a unique story with a really great team with a founder who had a previous exit, and they have a really wonderful mycologist on staff too, who's really helpful in understanding the mycology, which is a whole nother rabbit hole of science that's very difficult to know and understand well. But if you're good at it, you can make mushrooms do some pretty incredible things. So that's one example of a company. Another one is called Ecovative. It's actually in upstate New York. And they have what's called a mycelium technology business. So mycelium, if you're unfamiliar, is really just the fibrous roots that are the system that mushrooms grow from. So when you see a mushroom growing like in the forest and you see that cap, it's really just the flower of the mycelial network that's underneath the soil. And so it's that mycelial network that really creates the internet of nature that delivers information, nutrients, and so forth to plants, trees, and so on. And this material of mycelium is amazingly strong and can be kind of curated in ways to produce novel materials. So that's everything from alternatives to plastics, alternatives to styrofoam, alternatives to leather. And so we invested in this business because of that dynamicism in which they can deliver this mycelium technology, but they also have a killer mycelium bacon. And it's doing so well that they've actually spun that business out as a separate entity now that Ecovative still is the majority shareholder in, that's called My Forest Foods. And you might if you're in the market for these type of products, start seeing it now in the marketplace, because they've actually raised quite a bit of money and are now sort of pumping up production more meaningfully so that it's going to be available, across the country within the next, 12 to 24 months. And again, it's effectively one ingredient, which is mycelium, and then you've got like some flavoring, and that's it. And it's amazingly, similar, without sort of that fat and gristle that traditional bacon has, which is nice. But for people who don't love that, but love the taste of bacon, this, my mycelium bacon product is pretty impressive compared to other plant-based bacons, which I haven't found to be all that impressive. So those are two examples of mushroom-specific companies that we've invested in. We've invested in other companies directly that aren't funds, that are sort of addressing the food system in one way or another. But hopefully that gives you a decent overview of sort of the food system at large, why it's relevant and important to invest in from a impact perspective, but also from a, making money perspective. I mean, we all want to make some money too. And if you believe, as I do, that consumers and governments and corporates are going to want to deliver more and more of these things as we continue to enter into a very challenging and sort of bleak climate environment, that these companies, if they can hit the mark, should do very well. And the funds that invest in these companies, if they hit the mark, should do well, even though many of them will fail. And so that's a very important takeaway on all this, is that when you're investing in the private markets, even like the public markets, but even more so, it is inherently risky. And so you really need to be mindful of your exposure that you take on the risk that you're willing, to take on as well, relative to your own situation and your advisor's advice and so on. I think it's about 30 minutes of commentary, and I feel like it's a great time to pause and maybe just sort of open up the window for questions, either from you, Janine, or from anybody who's on the call that wants to touch on anything I've covered or anything that I haven't, or anything under the sun that's related to food and food investing.
Great. Thank you so much. And we do have a couple of comments about, gosh, can they want us to track the recommendations you made. And so I'm going to start with that, because you mentioned a number of funds. Often funds are closed. So once they do their raise, there's no longer an opportunity to get into them. So I'm wondering if any of the ones that you mentioned or any other funds that you're aware of are open or evergreen, so that people can still get into them.
Sure. Well, Desert Bloom, the one that I led with, is raising their second fund now. So that's open. The first one's obviously closed, back a few years ago, but they've fully deployed that. So usually what will happen is when a fund has raised a bunch of money, they usually take, anywhere between 18 and 36 months to deploy that capital. Once they've effectively done that, they'll then raise a second fund to do that all over again and hopefully raise even more money and kind of just keep on building on that success and raise multiple, they call vintages, fund 1, fund 2, fund 3. So if you've ever heard of big private equity firms like KKR and Carlyle, they've got, some funds that are like fund 14 and fund 16, because they've been doing it so long and it's working and it's just a cash cow and they just keep raising more money. So Desert Bloom is one. Ag Funder is raising an extra fund, but I think it's closing this month, so probably too tight. Clear Frontier is closed, but they'll probably come back into the market, I would guess, in the next year or two. And Sustainable Food Ventures, as I mentioned, is sort of a rolling fund. So every quarter you can write as little as a $5,000 check and then decide the next quarter whether you want to continue to do that or not. So if you just Google Sustainable Food Ventures Angel List, that should pop up, and then you can find some information on that. So that's sort of consistently available and will likely continue to be for some time. And the companies, Ecovate have just raised a pretty meaningful round within the last 6 months, and Fable did their A last year, and I'm not sure when they're going to come back to market again.
Okay, great. That's helpful. So, and that really goes to one of the other questions I had, and you answered it a little, but I'm going to ask you to expand if you can. So you work, I know, with high net wealth individuals. A lot of our members are not that, and some of them are not even accredited investors. So in addition to Sustainable Food Ventures, which you can get into for $5,000, which is great, that's a pretty low minimum, Are there other investments that you're aware of in the private markets that people can get into with relatively low minimums or through crowdfunding?
It is hard to find. They do exist. I'd say if you have an appetite for investing directly into companies, which is even more risky than investing in funds, there are some good syndicates that are out there, which are basically like investment clubs. And usually there's a relatively small membership fee, and then you get to sort of join into a group of often dozens or more of investors like you who are passionate about a particular subject. And that syndicate curates deal flow. So very often there'll be a monthly or a quarterly call, and they'll highlight the companies they've come across. They'll often have CEOs that are raising money come on and do a pitch. That's a really nice way to kind of become aware of deal flow. And sometimes if you're investing in those earlier rounds, the minimums can be a lot lower because it's very hard for companies to raise money when they're very early. And so if you're willing to take on more risk and investing in that earlier sort of stage, sometimes the minimums can be lower. I'll mention it only because I talked to them today. There is a ag tech fund called Regenerate. It's in the United Kingdom, but that doesn't prevent you from investing it, although I would be remiss if I didn't tell you to talk to your tax advisor about every investment that you make and make sure that there aren't any adverse tax consequences, even when you're doing stuff within the US, depending on the vehicle you're using. But that minimum is only 25,000, and they're going to be investing in a broad, sort of like ag funder, like a broad-based ag tech strategy of various companies trying to improve the footprint or reduce the footprint of the food system in various ways. Candidly, I haven't come across that many funds that have minimums below 250 or above. I'd say it is sort of a challenge of the industry currently, but I do expect over time, because we're already seeing it, that there are going to be more and more vehicles like Sustainable Food Ventures and like the one I just mentioned in Regenerate that will have lower minimums and will seek to democratize access. And I think actually this will be one of the ways in which AI is very helpful, because it will probably make the profit model of these funds a lot more realistic for having lower minimums and aggregating broader pools of capital. And part of that will be policy, because there are some limits that prevent people from investing in certain things if they're not accredited. And it's all meant to try to protect investors, but often it can have the opposite effect and sometimes prevent investors from investing in things that they do want to invest in. So I think some combination of progressive political progress in the coming years, coupled with advancements in technology that will make it easier to run a fund with lower minimums and still make it a profitable endeavor, that will increasingly lower minimums for more and more offerings.
That's great. And actually in the chat, somebody is recommending something called Vectors Capital, which is an angel syndicate that looks into clean tech, ag tech, etc. So that's
another one that I'm aware of is called Glasswall Syndicate, and that's another one too. It's called Glasswall Syndicate.
Glasswall.
It was based off a quote of Paul McCartney. He said, factory farms had glass walls, we'd all be vegetarian. And so they use that story to create the Glass Wall Syndicate. And so it's predominantly an alternative protein syndicate, but they also invest in alternatives to leather, alternatives to honey, basically alternatives to anything animal derived. And there's actually a number of venture funds that are members of that syndicate. It's not just individuals. And it's a good one for what it's worth, that from what I can tell.
That's great. So there is also another question in the chat. Is there anything that is past the pre-seed, seed, series age stage? Is the ecosystem broad enough for more of the growth equity capital requirement?
A very good question. So one of the challenges just in general for impact investing is that there haven't been a lot of growth stage vehicles, whether they be funds or even companies, to invest in, because impact investing, even though it's been around for a long time, has only really been sort of in vogue, I'd say, in the last 5-ish years or so, maybe 10. And even 10 years ago, it was more like housing, it was finance. But things like, outside of solar, like climate tech and food tech and water tech, I mean, that is still a relatively new development, with there being like very investable funds that were available and companies and multiple funds to choose from. And so as a result, you just didn't really have a need for growth capital because there wasn't venture capital. And so you are now seeing, however, some funds coming into the marketplace that have growth capital. One that I can think of is called Synthesis Capital. It's in the UK. They spun out of Jeremy Coller's family office. Jeremy Coller is the largest secondary private equity investor in the world, and has a particular passion for animal welfare. And so he was investing in a lot of these early stage alt protein companies just through his own money. And then the team that was running that spun out a couple of years ago to form Synthesis and focus more on that, B's and C's and later rounds, specifically because of this sort of gap in the marketplace. So that's one example I can think of. And I'll probably be able to think of one or two others before the end of the call, but nothing pops to mind at the moment. But it is worth mentioning, because of that question, that it is tough to find many growth stage just impact funds, let alone ones within food. And where you actually are seeing more of the activity is actually in more traditional funds, like a KKR, like a Bain, like a TPG. They're the ones who are investing in some of these C and D rounds. So like Ecovative that I just mentioned, which was that mycelium company, their Series D round was led by Viking, one of the most vulturous venture capital private equity funds on the planet, because they just see opportunity, they see growth, they see, a market. And so it's because these funds are around already and they're picking up on this climate impact story and have their own pressures internally or externally from an ESG standpoint, they're now the ones that are kind of moving most meaningfully into these later stages, because they're already set up to do so and see benefits to kind of dipping their toe into this marketplace. So it's less ideal from an impact investor standpoint, because the majority of the investments that those funds are making are not going to be impact driven, and they're just going to be sprinkling maybe one or two examples like an Ecovative into the portfolio. But I do anticipate that there will be more impact specific funds similar to these venture funds that I've mentioned that are going to be investing in more later stages. And that will be a good thing, not only just for the companies themselves who need these rounds of financing in later stages, but it's also important from a diversification standpoint, because ideally you wouldn't want to have necessarily all of your private markets exposure in venture. You would like to have some in private equity. You might even want to try to find, if you can, some debt that's private. And these are all ways in which you can diversify, in addition to farmland, your private portfolio, so it's not overly weighted beyond maybe what your risks can tolerate in any one segment of the private market.
It's a really good point. You're talking about the higher end. What I'm noticing right now is that there's also really challenges for some of the companies. So I'm actually invested in a couple of food and ag companies who've been around for probably 5 or 6 years, and they're hitting that point where they need that next little push of capital to get them over the hump and get them to profitability.
Yeah.
And right now is a really tough time to be raising. At least that's what I'm seeing. And I'm wondering if you're seeing the same thing too, and what thoughts you have for those kinds of companies that are just like on the cusp. And
I mean, this is
raise hard.
Yeah, I mean, this is just a challenge basically everywhere, beyond, traditional finance, impact finance, food, healthcare, you name it. And that's more of a result of just what's going on with interest rates, what's going on with the markets, and many of the high growth categories, collapsing pretty meaningfully last year and still limping along. You're only really just starting to see some IPO activity in the last 2 weeks. Feels like it's been almost a year since we've seen a meaningful IPO. And so just these later stages of finance, which you would call growth capital or private equity, are just, really struggling. And it's not specific to any one sector or impact. This is just across the board, because financing costs have gone up quite a bit because of where interest rates have gone. There was a lot of excess risk taking and excess valuations that were manifesting in 2020, 2021, coming out of COVID. And then that bubble burst last year. And so there's still a lot of healing that's manifesting in the markets, where a lot of funds are holding onto the cash they do have, because they're trying to keep the companies that they've already invested in alive and not necessarily investing in new companies. And that's going to take a little time to shake out, but we are starting to see some thawing in the evidence of the Instacart IPO yesterday and the ARM IPO. I think that was last week or 2 weeks ago. But it's going to, when you get that kind of a collapse, which I think is a fair descriptor of, sort of private markets and all thing risk, whether it was SPACs, whether it was crypto, even clean energy, a lot of these things are down 60, 70%, even still from last year. You don't necessarily bounce back right away. You kind of limp out of that. And I think there's just going to be still some more limping to be seen. And so what you want to hopefully see companies do, which you're seeing more of, is they do what's called bridge financing or convertible notes. They won't raise another formal round of capital, let's say like a Series C or a Series D. They'll just go out and say, hey, look, we're not going to price our round. We just want to raise like $1 million, 500 grand, $2 million, whatever it is. We're going to give you 5 or 6% interest on that money with a 20 or 30% discount on whatever the price ends up being when we actually do raise money. And that's an easier way to raise money in the short term before they're able to gobble enough interest to do a bigger financing down the road. And so I would say for companies that are struggling to raise money, convertible notes in the form or what's called safe notes are a great solution to bridge the gap until they can do a formal round. I mean, if they're a company like Ecovative or others that are just crushing it, like, money is still there. But for everybody else that are maybe doing well, but not meaningfully so relative to the rest of the world, it's still really hard. And that's just kind of where we are in the cycle.
Great. So I'm going to just ask folks, if you have a question, feel free to raise your virtual hand. You can put the question in the chat. It's probably the best way to do it. I know there's some women off screen. So if you have a question, I'm going to take the conversation in a slightly different direction as we wait for that. So we're talking a lot about these startups. We're talking about investments that are primarily available to higher net wealth individuals. One of the things that I really worry about as we look at the whole move toward organics and better food, and I think your Desert Bloom Fund is addressing this, but I'm worried that we're going to end up with a two-tiered food system where those of us who can afford to pay for really good quality food get it, and those of us who can't don't. And unfortunately, I think the majority of us are in the can't bucket. So other than innovators like your Desert Bloom Fund and people who are thinking about this food desert problem, what else do you see on the horizon, and how do we avoid walking into that kind of world?
Well, I mean, the reality is we're sort of already in it. And part of the, if you look at, single mother with 3 kids, I mean, the options are pretty small with regards to how they're going to feed their family. That's why quick service restaurants like McDonald's and Burger King thrive, is because they can offer that kind of food at a cheap price. But the trouble is that leads to obesity, leads to diabetes, and a whole host of other problems in addition to the carbon footprint of those foods. And so we're already sort of there. Food is not, sort of healthy food is not really a right at the moment. And so I'm optimistic, though, that because you have more companies focusing on delivering novel approaches to producing food and leverage technology, we're going to be able to continue to drive the cost down. I mentioned earlier about kind of where we are in the cycle and how kind of early all this stuff sort of really is. If you think about how old the food system is, and even how seemingly old the current industrial food industry is, you're talking like 1950s. I mean, they've got a 70-year head start for the most part on these upstarts that are just kind of figuring things out now. Now, thankfully, these upstarts have AI, they've got software, they've got other things that those companies didn't. And so it's a lot easier to figure things out now with a lot less money than it was 50, 60, 70 years ago. But it's still going to take some time to continue to figure out how to produce things in mass at a price that's affordable, that's delivering more healthy outcomes.
Right.
But I'm optimistic that we're going to get there, and a lot faster than we ever will if we ever were to under the current food system, which provides some affordability, but it doesn't deliver on every other sort of important metric when it comes to nutrition and health, and certainly externalities when it comes to climate and biodiversity and so on. So, yeah.
What I've seen is, the monoculture sort of approach that we've taken to agriculture, and trying to make our farming really, really efficient so that we can feed as many people as possible. We've exported our beliefs about how agriculture works to other countries, where it really doesn't work because of the way those countries are set up. And I spent a lot of my career working across sub-Saharan Africa and Southeast Asia, and those are some of the areas that I'm talking about, where you have
Yep.
tons and tons of smallholder farmers who have tiny, tiny bits of land, some of it not even contiguous. And I'm wondering, I know that you work globally, so I'm just curious how you see what's happening playing out in Europe and the United States and more developed countries versus how this stuff is playing out in less developed countries.
Yeah. Well, I mean, you're touching on something that is becoming an increasingly important aspect of everything we talked about today, which is an extension of national security, particularly in the shadows of the Russian war with Ukraine, seeing what that's done to supply chain, particularly of food and the food distribution that Ukraine provides to a lot of frontier and emerging economies in Africa and Southeast Asia and elsewhere, is the need to be able to produce more locally. And so this is being led by countries like Japan and Singapore, who import almost all their food because they're island nations. And they've got neighbors that are increasingly challenging, and don't know who's going to be their friend tomorrow. And so they realize, like, we got to start figuring out a way to grow more food at home and do so in a realistic manner. And so that's where a lot of this ag tech is coming into fore, because if you can grow healthy, let's say, tomatoes and avocados and other fruit and veg in a hydroponic way or in a vertical farming way, you can do that anywhere. You're seeing actually the UAE, who imports over 90% of their food, investing massively in these food tech parks. They're trying to create like a Silicon Valley of sorts for food tech, because they've got nothing but desert. They can't grow much. But what they can do is build big factories, arm them with, clean energy and LED lighting, and figuring out ways to grow fruit and veg and proteins in places that you just would never think one would be able to without this kind of technology. And so it's going to be these kinds of motivations that would make countries and actors that one would not normally think of as impact investors, who are funneling billions and billions of capital into these solutions because it's a national security motivation. And that's me kind of getting around to your original question of, it's going to be those kind of motivations that are going to make it easier then for every country and every part of the world, either through their own economic means or through other support networks, through the World Bank, the World Food Program, or elsewhere, that are going to make it easier for them to produce their own food locally and do so at a meaningful cost. And so that's one of the additional reasons why one can be excited about this, and where you actually see non-impact investors investing meaningfully in food tech and ag tech, is because they're motivated by this more than they are climate or water or animals or nutrition.
It's really interesting. One of the things, and I see a question in the chat that I'm going to get to in a minute, but one of the things that I think could be rethought for countries like those in Africa is the amount of money that we normally put into an investment is so much higher than what's necessarily required in that context, right? And one of the challenges that I see is that there aren't many funds that are capable, because the economics aren't there for the fund managers, to just make a 20, 50, $100,000 investment in an entity. But I've seen it work. For example, a small group of investors got together. We gave $50,000 to a innovative young man in Tanzania to start to get better quality fruits and vegetables from local farmers. And he has built that into a $10 million business, which does not sound like a lot from our perspective. But for a young guy in Tanzania to build a $10 million business off of 50,000 is pretty significant. And there's a lot of people like that on that continent that just could use tiny bits of money, and there's no structure really to provide it for them, which is really unfortunate.
Yeah, I mean, the only thing that I've really seen that sort of addresses that somewhat is the what you might call microfinance and SME lending, or what's called small and medium-sized enterprise lending. And that marketplace is actually getting much, much bigger because of the interest in impact investing, and a way for people to write smaller checks into things that are then basically lending money to these local lending institutions who then lend money to these entrepreneurs. And so it's not a perfect solution, and there's not enough of these funds that exist, and various other sort of shortcomings, but that is one way in which money is flowing into these communities. And a lot of it is outside of just like fintech and things like that, and health tech is going into smallholder farmers that need that kind of capital.
Well, the microfinance stuff is usually really small. It's like 500 to a couple $1,000s, which, so there's something in those markets called the missing middle, right?
The SME, yeah. So it's those
yeah,
SME loan funds that are cropping up. CIM, Community Investment
yes,
Management,
yes,
is one. They're in San Francisco.
yes,
Very good friends with that team.
great.
Another one is called Advanced Capital, I think is the
Yes,
name. I can
yes.
double check that.
Advanced growth trade, I think, is what you're talking about. Maybe is that it?
Yeah, hold on, I'll tell you in a second. Advanced Global Credit is the name. So they're another SME lender. And so SME is basically, as Jeannie mentioned, is so microfinance is very small loans, $500, $1,000. SME is going to be lending more like 100,000, 200,000, maybe even upwards of like $1 million. So it's much bigger loans, but still very small relative to the kind of lending that primarily exists around the world, where you're talking hundreds and hundreds of millions of dollars that are lent to big, food and agricultural businesses. So SME lending is a space to explore if you're interested in this kind of investing, to target these type of communities. And the added benefit is they're loans, so there's a element of diversification that you get here, because you're not often investing in the equity of the business. You're basically lending to that business, which can have some additional impact outcomes, because then the entrepreneurs retain more of their equity in the business, because they're not having to sell it when they raise money. They're just basically promising to pay people back with a certain interest rate, and they can keep more of their actual capital. So if that business grows from a $50,000 check to a $10 million revenue business, then there's some real equity there for that entrepreneur, so that when they ultimately sell it, it can be a game changer for them and their shareholders, and they've given up less of that equity over time than they would have if they hadn't taken a loan from a SME lender.
Right, and there's often lower minimums too, which makes it
exactly right, particularly with microfinance. But SME, there are some that have lower minimums.
Yeah. So question in the chat: when you work with high net wealth individuals and family offices, are any of them open to lower financial returns? Are they open to taking concessionary returns in to get the impact that they want?
Absolutely. Great question. This is what we refer to as impact first investing, as opposed to profit first. Or another way to call it is below market rate investing versus market rate investing. And so absolutely, I'd say the largest family that I work with is an impact first investor. And she is very motivated by impact and is much more interested in the outcomes of the investment more than the return of the investment. So return is good, it's nice, but that's not the primary motivator. And so yes, there are examples of this. There's one I can actually mention. It's an organization called Mad Ag, as in Mad Agriculture. It was actually set up initially as a nonprofit, which it still is, in which they were providing low interest loans and advice and whatever to farmers who were trying to convert from traditional practices to organic and regenerative ones. And they've just launched the sort of first for-profit fund that is going to, they had a first fund, but it was inside the nonprofit. They've now sort of spun out what's called Mad Capital, and Mad Capital is now raising what's called their Perennial Fund 2. And this is going to be providing loans to farmers in addition to know-how to help them make this conversion to organic and regenerative practices. But they are lending them at interest rates that's below what the market would normally allow. And so that's one in which you would call that an impact first or below market rate opportunity, because you're focusing more on the outcome more than you are worrying about getting the maximum amount of return or profit or yield that you could. Right. So it's not to say that one is better or worse, but there is certainly a lot less capital in the world that's focusing on this, concessionary below market impact first realm, which can be very important, particularly in the early stages. And there's even something called venture philanthropy. There's lots of different blended finance approaches that one can take. You can be what's called a first loss, sort of reserve on a loan. So let's say a business wants to take a loan, but they're early and it's inherently risky. And the underwriters are just like, we'd love to lend to you, but it's just a little too spicy for us. An investor can come in and say, well, what if I absorbed, the first $100,000 of losses on that loan, should they, occur? And then that investor says, well, yeah, well, if you do that, then we'll definitely loan them $1 million. And so there's what's called catalytic capital, where you can kind of do things like that, where it's sort of a form of venture philanthropy, where you sort of know you're going to be potentially losing that money, not even making money, but it's catalytic in the sense that that 100 grand that you're effectively pledging, which you can do through your foundation or through giving or whatever, will unlock $1 million of loans that they wouldn't have gotten otherwise. And so there are sort of approaches along this, what you call spectrum of impact, which all the way over here is your bloodthirstiest, let's make as much money as possible impact investors, to your philanthropy. And then you've got these sort of variations of return and impact that you can try to find. And so as an investor, and certainly as an advisor, we think about that spectrum and understanding what clients want or how to deploy intelligently across that spectrum can allow you to have even more impact than you would if you were just focusing on one or the other.